Welcome back to Finance News. This is episode 23, and as always, it's been a crazy week on the stock market, and there's always something to talk about. Let's jump straight into the headlines to make you feel a lot better about all of the losses in your portfolio. The markets this week have continued the pain from previous weeks, with US stocks taking the brunt of investors' fears. US stocks suffered their worst day since June 2020, taking a 4% hit. 98% of the index fell on Wednesday, giving investors nowhere to hide and turning everything into a shade of red that we'd all rather just avoid. I've got no idea what will happen on Friday's market, as this is when I film and edit the news, but I have a suspicion that stocks could either go up or go down. Dragging the market down this week were results from major US retailer and one of the largest companies in the world, Walmart. The retail giant, famous for its huge stores and low prices, delivered a lower than expected earnings announcement, showing a potential cooldown from US consumers as fears of inflation and a slowdown in the economy curbed excess spending. Walmart's share price is down nearly 20% this week, its worst pull down since 1987. Company CEO Doug McMillon said that the inflation for food was running at a double-digit pace, and he was concerned that inflation may continue to increase pressure on both the company and its customers. People in stores were flocking to buy less branded goods, fewer household items, and he forecasted that expected net sales to increase by 4%, although earnings per share would be down 1% because of the unexpected costs that have started to creep into the business. Another US retailer, Target, faced similar pain this week, dropping its share price by 30% after reporting quarterly earnings that fell short of analysts' expectations. They also experienced higher costs of freight, had to provide bigger discounts, and also saw a drop in the buying of items like TVs and bikes. Moving on to some clickbait headline style news this week, news outlets reported that Tesla had been removed from the S&P 500 index. In reality, the company had been removed from the ESG version of the index, which is managed by Standard & Poor's, and it's based on credentials they monitor from environmental, social, and governance aspects. The ratings and index company said that Tesla lacked a low-carbon strategy and also noted that their working conditions at their Fremont factory in California were pretty poor. Remaining on the list were Apple, Microsoft, Amazon, and ExxonMobil. Musk retaliated to the news through his favorite outlet, Twitter, where he wrote that ESG was a scam that had been weaponized by phony social justice warriors. He also added that the S&P Global organization had lost its integrity. In previous tweets, the Tesla boss had been critical of ESG, calling it the devil incarnate. I think it's safe to say he's not a fan. In more Elon news this week, the Twitter acquisition is looking more shaky after Musk was critical of the company's handling of those fake bot accounts. In a thread by the Twitter CEO Parag Agrawal stating that fake accounts made up less than 5% of the user base, Musk hit back claiming that the way they gathered the data was poor and used an emoji reflecting his feelings. It's the brown one with eyes. The share price of Twitter this week is down a further 7% after being down nearly 20% through the month, sitting at a considerable discount to the $54.20 offered by Musk for the takeover deal. Some commentators have suggested that Elon is trying to back out of the deal as the overall sentiment in the market is working against big tech, including reducing his own wealth as investors move all their Tesla positions through fears that the billionaire is wasting his time focusing on the deal. Twitter's top lawyer and head of policy, however, told workers at an all-hands meeting that the deal is moving ahead as expected and they don't expect to negotiate any terms, including the pricing of the acquisition. As usual, I'll keep you updated next week if anything changes because something always happens. Jumping over the pond closer to home, check out this random news story I found. If you're looking to make money during a recession, just stick up a traffic camera in London and you'll make a fortune. At Bank Junction, pictured on screen, is the single most lucrative traffic camera in the country that's catching motorists who aren't allowed to drive through the junction during certain hours of the day, excluding buses and cyclists. Through a Freedom of Information request, it turns out that the system of cameras was pulling in £15.2 million, which is nearly $19 million over the last 3 years up to 2021. In 2021 alone, the camera made £3.2 million, nearly $4 million. If you do get caught in the zone, it's £65 a time if you settle your fund quickly, otherwise it's a lot more costly. Now that's a business we can invest in. Can we get a traffic camera ETF or index fund going? I'm all in. And last from the headlines, McDonald's has announced that it's finally quitting Russia. On Wednesday, the fast food restaurant chain announced that it will sell its Russian business to a local licensee who will continue to operate the chain but under a different name. The buyer, Alexander Govor, had begun operating Russian McDonald's 7 years ago. It will be taken on more than 800 restaurants across the country. Before the news, McDonald's had operated the majority of its stores directly rather than by franchise, taking on 84% of the business. There were no terms disclosed for the deal, but McDonald's had previously said they were taking a $1.4 billion charge. I wonder what the new branding will look like. I'm expecting some pretty funny rip-off, but Let's wait and see. And now let's jump over to fails of the week, where we look at some of the lighter sides of the news and remind ourselves that people can be very stupid indeed. Just when you think it couldn't get any worse, fails of the week. Up first, the ape movement have been patting each other on the back this week and picking fleas off their backs as they saw the news that Melvin Capital, the hedge fund who got caught up in the GameStop short squeeze, is looking to wind down and return all of their clients' money. The fund lost billions of dollars during the meme stock rally last year as they'd bet on the price of GameStop, the US video game retailer, to actually drop a lot further. Unfortunately for them, an army of retail investors ended up buying shares in the oversold company, forcing them to cover their losses and losing billions of dollars of their investors' money. Gabe Plotkin, the firm's founder, told clients that he planned to return the cash to investors because the last 17 months had been extremely difficult and he no longer wanted to manage money for external clients. The company had managed to make up some of its losses after this event, but its recent first 4 months performance for 2022 is a negative 23%, in line with the tech sector sell-offs. And now let's head over to the house favourite section, where I've pulled 4 of the best posts from Reddit's Wall Street Bets this week. It never fails to deliver week in, week out. Welcome to the best of the bets. This week, Jim Cramer may have just signalled the first step toward the world's end. Remember how we said that you always inverse Cramer? Well, make sure you tell your loved ones how much you love them tonight, get your bunkers ready and head to the basement, everyone. I think it's about to get a little bit crazy. This video is something we can all resonate with, not because some poor guy spent loads of money on a toy aeroplane, but because history repeats itself. Literally, the moment you make the investment, after hours of research, everything seems to hit the price at once. I don't think that's ever going to change, but be careful out there. Just remember to stand back. I don't even have to say much about this video, the caption says it all. When you're 90% down but you have a 3% green day, nothing quite beats the feeling. Just don't remind me that to get back the rest of the 90%, I need to 10 times my investment. And finally, let me leave you with this one. If you've only just started investing recently and you got all excited about building your wealth, just remember that it's all about the long-term view. Otherwise, there's nothing else I can do to help you. There will always be that one person who invests everything right at the top. The problem is, we just don't really know when that will be. And on that bombshell, thanks for watching. If you are in the mood to see why the markets crash and how you can protect yourself, watch this video next, or check out my current performance of my latest Vanguard portfolio. I've made a lovely thumbnail that's in the stock market's favourite colour, red. Anyway, I'll see you the same time next week for finance news. In the meantime, happy investing.